Hey viewers, welcome to our weekly update, and this week we will be taking a look at forecasting. Forecasting is the act of making prediction, in this context future prices. That's what will be the movement of our currency pairs based on historic and current data. Before we proceed, if you have not subscribed to our channels, please hit the subscribe button now and also like the video. So, as I said, we will be looking at making forecast for price movements based on historic and current data. And to do this, we will be using so a combination of tools as usual. Some of them we've talked about them, introduced them partially in the past, but today we will be looking at it fully to see how we can, what type of strategy we need to hold on to consistently to see that we make the best of our tradings. Our objective today will solely be on the use of the Elliott Wave Theory. So in this case, we will be using the Elliott Wave Theory to see. First of all, I will give you the theoretical definition of what the Elliott Wave Theory is, and then straight we'll go to the map to the chart as usual, and then play it out and see what we have in stock. So here I made mention of market psychology and sentiments. Market psychology and sentiment is actually the collective emotional attitude of traders and investors that influences buying and selling decisions in financial markets. Not only forex, we have other financial markets. We talk about the cryptocurrencies, future trading, and etc. So, but in our context today, we'll be, as usual, we'll be focusing only on forex and, most importantly, gold analysis. That's the currency pair, dollar gold. So, as I said, this is the tool we'll be focusing on. And what is this Elliott Wave Theory? It's a tool that is used in forex trading to analyze price movement. It has a 5-wave pattern. We have 5 waves, of which you have the impulse waves and the corrective waves. The impulse waves are actually the waves that moves in the trend, the market direction, and then the corrective waves are those one that more like retracement. They retraces back, then it makes another impulse wave, and thereafter we have some correction that in the form of ABC, and then potential turning. So in summary, the wave itself is used to identify the turning points in the market, either through the first run of waves, the 5 waves, or even after the ABC wave. So it gives you potentially that yes, we are at a turning point in the market. So we will go for short break. When we come, then we go into our charts. This is just an overview of what we want to talk about. Then we'll go into the charts, and then we go practical. That is the usual way we do this, because if we want to go theoretically, we might not understand the concept we're talking about. Okay. Welcome back. So as we mentioned before the break, we said we're going to go in details to explain the Elliott Wave Theory, and that involved the impulse waves, which is the first 5 waves, and then the corrective wave, which is usually 3. That's the ABC. So for the impulse waves, the wave one, let me bring a blank side of this too, so that, okay, good. So I will give a pictorial view of what I'm talking about, and this wave theory is actually applied in a trending market. We have to know this, that this happens is applied only in trending market. Either the market is trending upward or the market is trending downward. In a horizontal market, the wave theory is not applicable. Okay, so this is the first thing we need to understand clearly. As I said, it's either the market is trending up or the market is trending down. So usually the first wave begins either with an uptrend, and it usually happen after we have some corrective moves. Okay, assuming we have markets behaving this way. Okay, you have some corrective move. This is sideways market, right? Then all of a sudden something happen. Either you have a break like this, then let me drop this here. If you check with this is happening sideways, right? It's coming from left to right. It's not making a clear move up or a clear move down. But all of a sudden, let me put something across this. This is what I'm talking about. All of a sudden, you notice that, hey, it seems this has broken out of this channel. It could be sideways channel, it could be flag patterns, whatever it is, but there are a lot of, this is what we call the consolidation time. After that, this happens after either an upward trend or a downward trend movement. So when you spot this, when you spot a break outside the regular channel, what you look out for is that, is there a retest? Yes, there is a retest. Then this signals a potential upward movement. We'll go back to look at it on the charts that itself. So, but first of all, before we go to the chart, I need to explain the concept, how it looks like, right? Let's take this out. Let's take this out too. So for the waves itself, as I said, the impulse wave has 5 different waves. Wave 1 will begin, and either, let me use an uptrend for example, after the correction or consolidation. So wave 2 will be the corrective wave retracting. Let me do this. As I showed in the first example, we said something like this happened. It retraced back to the zone where the breakout start from. Then you have something again like this. You have another retracement somehow. And then like this. So in the this is how the impulse waves look like, where we label this, let me see, we label this as 1, sorry, that's the 0. This is the starting point, right? Not 1. This is 0. Okay, if that's the starting point, that is 0. Sorry. Okay, it's not, leave that alone. Then we have, this is 1. Take this. This will be 2. do it, my friend. This is 2. I will explain it. Let me just finish the labeling. Come here. This will be 3. Here. This will be 4. And here. This will be the 5. Okay. I wouldn't want to. I don't want to take much time on this. It's not adjusting. Okay. So, but ideally, this is how the I will use what's it called? We have the tool to draw this directly here on TradingView. We'll look out for it later after this explanation. So this is what happened. Immediately it breaks out of the trend. Then we call this the first impulse move. Then you have a corrective. Then you have this. Usually 3 is usually the longest. There is a ratio to this. Then you have 4 and then 5. So there are also some basic rules that you need to watch out for too, because the ability to actually get this correctly has a lot of impact on the trade itself. If you place it wrongly, or if you forced it, then you would not get the advantage of what we're talking about here. So for the first wave, as I said, first wave is usually the longest wave. First wave is begins in this. Once you see a retracement like this back into the zone where where you had your consolidation, then you begin to count. So this is 1. Then wave 2 is a corrective wave retracing part of wave 1 move, not fully. Sometimes you see it's just part of it, it's not completely. Then 1 or 2 forms a complete circle. Then wave 3, usually the longest, as I said, and also the strongest. This is what actually people that understand the use of this tool, this is the one they look out for to take advantage, because it's going to be more like a full breakout. And then wave 4 again is it's a correction, though less extensive than wave 2. Sometime it's not this long. It's just let me adjust it. For example, it's not usually as extensive as 2. It cannot go beyond this zone. Okay, this is the 2. And wave 5, also the final impulse wave, reaching a new high. Okay, because it breaks this, or sometime it can end within this also, not actually breaking it, depending. So it could end here instead of going beyond it, but in most cases it goes beyond it. Then after this first 1, 2, 3, 4, 5 movement, the corrective wave ABC also sets in. So what happened is that wave A would correct against the preceding impulse wave, which is this 5. It comes like this. It comes like this. Then this is A. Yeah, here. A. Then you have its own corrective wave 2. So it retracts this. And C, which is the final one, is usually most powerful and completing that trend. If you see here, sorry, let me complete it here. So as I said, this will be A, this will be B, and then this will be C. Usually this C is stronger in a way, which is also likely forming another direction. So this is the okay, just I won't label this in the interest of time. I call this A, I call this the B, and then this is the C. So this is an example in the upward trend. Then in the downward trend, the reverse is the case. Can I invert this? Okay, no. Then if not, let me do something different. I need a clean space. Okay, then I have to delete this so that I can. Okay, first of all, before I do that, if we check here, as I said, this is in an upward trend. That's trend from, we see it was going up. Then the reverse is just either you are able to copy this, reverse it is where we have the downward trend, where the trend starts from somewhere up here and then it goes down. Okay, so towards the end of the video we would also show on the chart how we can plot this this correctly, and then look at the what information is giving us. So first thing here is that to apply this correctly, it is good to do this analysis in the higher time frame with a combination of other psychological tools like the Fibonacci retracement. Okay, and if you are following our video trends, we talked about the dollar index in the last video. If you have not watched it, you can go back to look at it. Today I will also bring it as part of the analysis that we will do to see the use of this Elliott wave. Okay, so this is a brief summary of the description, and what we'll do next after the short break now would be to go into the chart fully. That's to go into the charts and see how we can whether we spot a trend like this, and see how we can place this tool on it to make some market decisions. See you after the break. Welcome back. Before we go into applying the tools, I need you to take note of something on the screen you are seeing now. This yellow line is actually my 200 exponential moving average. This makes it easy for me to detect when I enter a market to tell whether the market is downtrend, uptrend, or consolidating. So when the chart is above the 200 moving average, it tells me that the market is in the uptrend, and when the charts are actually below the 200 moving average, I can tell easily that the market is in downtrend. So if we see this chart on the screen, this is a weekly time frame. Let me start from here, 2001. Here we could see clearly that we had an uptrend here, and then we have a downward trend here. Okay, and most time when it's a bit difficult for you to identify which to identify the turning points on the screen, what you do easily is to turn it into a line chart. Then you can see in clear terms where the turnings are happening. So first, before we go into this, I need us to recap what we talked about on the wave theory. That it happens, it's what it helps us detect is it helps us detect the potential turning points of these markets, and then so that we can make some market decisions. So if we are looking at the chart here, and if you remember our lesson from the Fibonacci retracement, it's also a psychological tool that help us mark some it helps us mark some potential turning points of market sentiment. So either you bring in the first if it's easy for you to tell that from here, I think this is the neckline here, I'm seeing something like a double top. Let me take it back to this. So here, see more like a double top here. Is it a double top? Yes, it is a double top, because let's read that correctly. When we have this here, so this zone here where this market reach here, you have this also touching it here. So this is a double top, and then it eventually formed an M pattern, which is a reversal pattern, and we saw it clearly afterwards that yes, the market do actually reverse downward. So what we do in this case is, at what point was this broken? Right, this neckline was broken here, which will tell us that this is our actually first impulsive move in this case. So what we said is that let me now use this. I can use this as well to mark that consolidation region, so that we can tell when we broke out of that. Okay, this happens to be the region of consolidation. Yeah, this is the region. Within this region, the upward trend from here actually ended. You have it move around here, then it breaks out here. When it breaks out, it forms this, then down. Okay, so let's look at this, that when it breaks this neckline, what happened? Okay, you have the break here, it retested it, then it begin its own journey. So going back by the concept which we have described before, is that we saw after the consolidation, we saw a movement down, it came back up, it went down again. Okay, it came back up, it came down here. Then if we count the A, B, and then this we can call the C. Let me stop here. Let me change the color to something else. Let me change it to blue. Okay, so let's see if this fulfill our 1, 2, 3, 4, 5 that we counted before. As I said, you have this region of consolidation, or a turning point from the initial uptrend. Then it breaks it, it came back to retest, then down again, and this. So you would ask me, why did I not we have this other in between movement? Why didn't we make the turning here? There are actually mathematical rules that guides the length of these individuals. So if, let me bring my drawing tools, and this is also where your Fibonacci retracement comes in. Before I even go to the drawing tool, let me use that. If I place the Fibonacci here, okay, it's weekly. If I place the Fibonacci here, we will see that here, when this breakout happened, it went to the 0.38 zone, it retraces back to the 0.23, it came down to the 0.78, retraces back, then it went to the 100%, right? So this is first indication, which is more, at least we took lesson on Fibonacci retracement. You can also go back to watch that video to understand how this behave. Is a natural thing. So this is one confirmation. The second confirmation, which is mathematically, is that we usually measure the length of this and then multiply it out. If I take this here, I said from this 0 point down to this point here, I had, which currency is this? Okay, I have, if I look here, I have 759.3. I can use this, 0759.3. Okay, the currency pair here is Euro USD. So 07593. Either this or this is easier for me. 759.3. On your calculator, if you do 759.3 multiply by 1.618, this gives me 1228.54. So what we're going to do is that from here, from this point 2, you will measure a length of 1.228. That is the minimum that the wave 3 would take. Okay, where is the ruler again? Here. That's if I'm not using the Fibonacci zones. I will look for 1228. This is 1, 2, 2. Yes, around this region. That it is going to travel minimum this length from here to here. That is going to travel this length before we have the, which is, you see, it's going to the 0.78 region. So it's going to travel this length before the next turning happen. So with this now, if we check and look at that point, actually here, the 0.78, the 1.228, another movement happened. It breaks and it comes back. So in this case, let me move this here, that this is actually my third wave. It came back here, then it comes here to complete the 5, then A, this is my B, this is my C, then consolidation, I have this here, then it consolidates here. I think you have another up here, you have down. Let me add more of this. You have up, you have down, you have up, you have down, then before it breaks out again. Okay, let me add this one here. So maybe I'll change the color of that consolidation. Let me zoom this out so that we see it clearly. Yeah, now I take out the Fibonacci. Yes, so this is the consolidation. Change this one to a different color. Let's say take no is it going to be visible? Green, no, it will confuse us, right? Let me change it to, just pick any color. Let me change it to this. Yeah, so we have consolidation happening here. We have some consolidation again that happens within let me use another tool. Let me use this, that we have consolidation happening within this region before it breaks out of that zone again. Okay, so what we are saying is that the run from here, 1, 2, 3, 4, 5, then A, B, C, then consolidation here, or usually you can break this into major and say, okay, this is the fifth one, A, B, C, whatever. But the major one that we usually target, which has the longest move, is usually this wave 3, and this is what gives us the highest profit. What also happened is that if you check, what I did here was that I was looking at the weekly time frame. If I step down to the daily time frame or the lower time frame of this, you will see that within each wave, each impulse movement, there is also a series of Elliott wave in between them. You can see clearly from here 1, 2, 3, right? If I go to the daily time frame for this, let's go back here. Let me make the visibility such that we can view this even. Visibility, tell me settings, yes, interval and below. So this should be visible in the lower interval. Visibility, interval and below. Okay, good. So that when we go to the lower time frames, we can still see these moves. Okay, it's sorry, it's far back. Okay, yeah, here it is. Okay, super. Okay, so you see, what I want to explain with this is that within each, because we use the weekly time frame to do the analysis, within each of these movements, right, you also have a series of smaller waves happening in between. So it's not just that, okay, you jump into the chart, you see this, then you jump into it. No, it needs a lot of patience, right, for you to be able to mark out these zones correctly. And which, if you look at here now, it is a bit clearer here that you have 1, 2, 3, right? But this is just the wave 1. Also within this wave, if I still go down further, you will see that you have some series of movement here. It's not a straight line thing that, okay, immediately I see this is this. No, but what actually happened is that, first of all, know your market trend. To know the wave, the particular wave you are in, 1, 2, 3, 4, 5. Then with that, you can now go into the lower time frames to actually catch the trend. Usually we advise that you trade the trend, don't trade against the trend. Okay, so trading the trend would actually give you more returns on your trading than actually going independently. So what happened here is that on the daily time frame here, we are able to see that, okay, there were series of smaller movement as well. And although I don't use the wave theory beyond the 4 hours time zone, because I'm actually I don't trade below the 15-minute because of the noises. That's 1 hour, below 1 hour definitely, because of the noises that are in the market. But if you do, the wave theory still works even up to 1 minute if you are fast. But note that there are more noises there compared to where you trade the weekly or daily time frames. So recapping this, we see that the wave theory, if applied correctly, like in this case, we said this is the wave 1 in that weekly time frame. Let me zoom it out to see what wave 3 looked like here. So you see the wave 3, you actually had a lot of consolidation here. It broke it here, it came back, then again you see series of short movement like what we have in the bigger time frame. In this case, I would want to that after this is the first one here. Yeah, just readjusting. I place it on time, but now readjusting it to match the the wicks of each of the turning points, right? So this is it. Applying it correctly will actually give you a very good return. And then you have another series of consolidation down here. Consolidation, and after this consolidation, we saw that it again breaks out of this zone. When it breaks out, it did a retest, then usually you start your counting again from here. Okay, another form, yeah, you start your counting again from here, and then you trace it up. Either it is the is it the in the bigger time frame, is it the corrective wave, or is the impulse wave that has also started? Usually it also follow this pattern, that when you have an impulse wave, the corrective wave, that's it follows the pattern 5 3 5 3 5 3. Okay, don't confuse the 5 3 5 3 5 3 with the 1 2 3 4 5. Okay, the 5 3 5 3 is such that if you have an impulse wave of 5, then it's also followed another 3 waves. Again, it repeats 5, it follows another 3 waves, it repeats 5, it follows another 3 waves. But the major thing is that know the trend you are in, and also be able to analyze. If you see here, this looks like consolidation, right? This is the weekly time frame again. Okay, this is a consolidation here, and this is taking us closer to the actual current trend in the market. So in this case, after this consolidation zone, let's see if we can mark something out here again. I would say that here to here, yeah, we have series of up and down movement here. So there is a break here, right? When this break happened, it came back to this region again, more like a retest of this region, and then went bam. So what we'll say is that we could now count this, that from this break, this is 1, this is 2, then if we are looking at that, has 3 formed, it's a yes or no thing. So how do you know whether it's a 3? And if it is a 3, if it's a 3 or not, also I talk about 5 3 5 3 5 3. So this run here, is this the run of 5? If it's the run of 5, then we expect what will follow to be the run of 3. So if it's the run of 3, what happened after consolidation, then we begin to look for another 5, and usually it will be in the opposite direction. This is one way or the other. Then here, in this case here, we had clear, if we look at this looks like 1 2 3, then which means this could actually break into the 1 2 3 4 5 before this consolidation, then 1 2 3, and maybe we will also have another look at 1 2 3 4 5 here. Let's go back again and again. If this is a 3, what do we have here? We had a 5 ending here, right? Then after this consolidation, do we say 1 2 3? Are we still consolidating? We consider all this as consolidation. If not, then 1 2, is this a 3? Then is this a 5? We need some support to actually check this. So looking a bit confused, then let's check if we can get that clarity with the line. Okay, 1 2 3 1 2 3. Okay, we have consolidation here, it breaks, then it returned back here. It didn't take this region. Okay, good. Let me use, I need to place the Fibonacci tool here for a guide. Let's take this run, high to low. Okay, these psychological regions here, 0.38, it came back, 0.78, it came back. Okay, 5 is here. Then this is a run of 5, 2, 3, it came back. Then if we measure the length, 7, 8 came back. This is 5, A, B, C. Then consolidation here, it breaks it again. Okay, so in that case we'll be looking at this as 0. I think we have the wave theory tool here, Elliott Wave. Let me look for it. If I see the tool itself, Elliott, it's easy to it's not here. Is it here? Yeah, Elliott Wave 1, 2, 3, 4, 5. Let me use this. So as I said here, we have after the consolidation, we have a W formation here. Then it looks, this is the first, this is 0, let's say this is 1, 2, is this the 3, is this a 4, is this a 5, or the reverse is the case? Is this a 5 or this is the 5? Then you have, okay, so let me change the color of that to be I need something different. Let's use red. Okay, good. Take this out. Let's take this out so that it is clearer. Take it out. Then let's return this to, we are in the weekly time, in the daily time frame. Let's return this to candlesticks and then use it so that we can drag it clearly. So this is 0, we call this 1, it came back to retest this neckline. I take this out too. It came back to retest this neckline now. Then it went up to this point, call it the 3. It came back here. Then it came up here as 5. What we need to look at here now is, if this is 5, this is A, B, C, then consolidation happening, right? Consolidation happening. Where did I pick it from? I picked it from here. Then let's look at the ABC. You have ABC, you have ABCDE. You have the double, you have the triple. It depends on how this is A, B, C. Then what this means is, after this correction, then it could also be another ABC, or the new wave can start automatically. But from what we are seeing here, the new wave is not starting yet. It's not starting yet. It's maybe waiting for some factors. ABC, which is the longest, yeah, C. So this is what happened here. Now what's going to happen next here is that It's either do some corrective moves in between here, where we are now looking out for the breakout. Okay, we are looking out for the breakout of what is going to happen next. And to support this, to help us in this direction, we need to look at something which is I want to go to, okay, this is Euro USD, right? I want to have a quick look at the the dollar index. What is happening in the dollar index? If I look at this, I was looking at the analysis before. If I look at this in the dollar index, something interesting is happening. Can we also look out for that mapping of can we look out for the wave theory here? What does it look like? What is happening? Can it give us an insight of what the next possible movement of the dollar index would be? Maybe this will give us a hint of how the other currency pairs are going to behave in very short. Let's look at this. Let me pick it here. I peg it here. Okay, before this analysis, we look at this. After this termination here, there were a series of consolidation. Let me take these 2 points. Let me take it like this so that it is clear for us when it exits the consolidation zone. Okay, consolidation was happening within this region, right? When it entered this zone, we had this series of movement, and then this is the breakout here. So the breakout here would actually serve as our counting. No, okay, this is the neckline here, right? It breaks out here, it came back in to retest. Is this clear enough? Let me check through the lines. Yeah, not perfect, but yes, there was a retest here. So this retest, meaning this is the first run. With that retest, that tells me it's the first run. And what I would again look out for is I will have to measure mathematically if that run is if the third run is complete or not. Usually I said the minimum is 1.618. If I take this length here, if I say from here to this point, what does it measure? It's measured 1699. 1699. Sorry, I'm with my calculator now. 1699 multiplied by 1.618. The value is 2748. 2748. So I will take another measurement from here this time to look for 2748. This is the ruler from here. 2748. Oh, super. 2741, 2748 is after this line, which means we can count this as our third zone. So in that case, let me come back here. Let me pick my 1, 2, 3, 4, 5. I said this is the starting point, 0. This is my 1. This is my 2. This is my 3. This is my 4. 5 has to be with the same length or below this, which is this. This is my 5. Then in this case, I would have my I will have my 0, A, B, C, then some consolidation, and look for the next break again. Okay, if I bring my Let's bring the second one. ABC, this is 0. No, this is 0. A, B, C. Then there's another A, B, C here, I think. Okay, so here this is the end of this run. Then we have some corrective moves here that is happening, and this is one. Secondly, if we say, let me return it to graph. So ABC, sorry, let's correct this. 0, A, B, C. Okay. 5, then 0, A, B, C. Okay, so here you have another 1, 2, 3. Yeah, you can see we have the corrective moves, the consolidation happening here. We cannot tell yet, but we have to look for what pattern is this and when is it going to break out of this. I will go back to the lines again to see if I'm able to get something. What I see here is no, not using this. Let me use this one. What I see here is I will mark this point, I'll mark this point, then I'll do something like this maybe to tell if when we're going to have a break here. There is still nothing tangible to look at here. And now this is where your fundamental analysis comes in. So what is going to happen next will have to do with maybe news events happening that this region would now be broken. So once this region is broken, then we can tell again that okay, this is the possible next direction. Now looking at the other side of the analysis, I told you at the beginning that when we look at the 200 EMA, then if the chart is below it, we know it's in the downward trend. If it's above it, it's in the upward trend. Here the chart is below the 200 EMA, which means potentially we are still in the downward trend. This is the I think this is 50. I marked it 50, right? EMA, what are you? Okay, this is the 50 EMA. We see here that the 50 EMA crosses the 200 EMA here, which is an indication that there is still a strong momentum that this would go downward more. Then in the what's it called? The candlesticks themselves, we see a lot of pressure here. Let me take this red out so that it will not confuse us. Here you have indecision, then but more towards a selling pressure. And what does this tell us? If that is the case, if I'm looking at the entire region here, after the completion of this, if I'm taking this entire region, let me take this entire region for my analysis. I can also tell that you have down, up, then the next possible thing is that this will be coming down. Okay, if this is coming down, where is the potential region that I should also have pay attention to? I'll be paying attention to this region. Okay, I'll be paying attention to this region, meaning there is possibility that this is coming down to this region. Okay, so if it's coming down to this region, what happened? Remember, this is the DXY. DXY is that if this is coming down, then the opposite side will be going up, right? When I say opposite side, we're talking about the gold analysis. Here again, look at what happened here, more like an inverted hammer, though not a hammer. This is a butterfly. The indication here is that there is a selling pressure here. That is why it closes here. This opens below at the same point here and is still going down, right? So if we see this break below, there is news coming up if it has not already happened. Dollar steady as market assess higher than expected US CPI. Dollar gives up early gains as still whatever it is. These are earlier news. What time range? Daily. Okay, so but if this turn out to come towards this is the region we're looking out for, meaning DXY going down, then the gold price, which is the alternate one now, would tend to go up. Okay, this would be fingers crossed, but I need to see if I go down, let's say 4 hours, what's happening there. Okay, you could see it's still series of up and down, right? It formed an M here sort of, but instead of this retest and breakdown, it retest again. You see it's hitting the 50 EMA, as it's using the 50 EMA here as the resistance, right? It came in here, go back, came in here, go back here. Now if it breaks it here now and retested it, then the destination would be that zone I marked earlier, which is here. That this is in the 4 hours. We'll be looking at it coming down here. What that tells us that gold would actually move up in the opposite direction. So this is where I would stop. I would fingers crossed. I want to see what happened. Let me use, I prefer using this. Let me use this high, and this. Let's see when this breaks. Oh, again, something interesting. You see 1, this is 2, likely the 3 might also be coming down here, which means in the short run, that is the 4 hours time frame, if I go to gold, we should be doing the opposite, right? XAU USD, XAU USD 4 hours time frame, yes, it's doing the opposite, right? So likely we'll see some little movement upward here, and then that is it. So but also gold itself is also consolidating. If I pick this region here, pick this region here, which one? This one has more resistance. Let's pick this. Let's do this. Then let's wait to see what happens. Is it going to come back down, or is it breaking it already? If it breaks it, remember this is the 50 EMA here, which means if it's using this as the resistance, it might break it up. Okay, fingers crossed. I'll take this one out. I'll take this out, then I'll watch out to see what happened after this consolidation. I can take it up a little here so that I use the bigger picture. I will consider this as an outlier only. I could also consider this as an outlier, which is this one. Consider them as an outlier because we have more points here. So let's see what happened within this region. If it breaks it here, of interest for me is to see what happened when it touches the 50 EMA. If it touches it and retraces, then it's retracing back downward. But if it touches it and breaks it, then we might be looking at a new trend forming. Yeah, there is a news. PPI month on month forecast is 0.1, previous is 0.1, then whatever the actual may be, which is today, my time zone is saying by 4:30 p.m. today. So whatever that be, it might have a lot to play here. So this is where we will stop for today. I hope we have been able to give you some insights on how to apply these tools. And as I said, the Elliott Wave it works perfectly on the higher time frame. In the lower time frame, yes, it works, but there are a lot of noises. How to eliminate these noises, instead of reading from the candlestick directly, take the line chart so that you can mark out clear points, okay, for you to make your analysis. Happy trading. See you next week. Do subscribe if you have not subscribed to our channel, like the videos, and then happy trading. I would also like to see your comments on the chat section. If there are things you need clarification on, please do. We will go back to make those clarification. Thank you. Bye bye.